Hey guys, what is going on? Welcome back to the channel. Again, I want to thank everyone for all of your support on the channel. All the viewers, all the subscribers, immensely appreciate the support. Today, I want to jump back into the portfolio to discuss options trading once again. I made the second options trade on the portfolio, this time doing something which is called a covered call. So basically with this video, I want to go through what a covered call option strategy is. I know there were a number of viewers asking about this particular strategy, and really the idea behind this is making a premium, making a rate of return on stocks that you hold for the longer term, buy and hold stocks that you have in the portfolio. We'll kind of discuss exactly why I'm doing this type of strategy and what the benefits are. We'll also talk a little bit about the downside risk, but the downside risk is very, very small, and for the way I'm doing this, there's essentially no risk in this options strategy. So as we take a look at Ford here, you can see in the middle here options. You can see now I have 11 contracts. If we take a look in the middle there, that first contract was what is called a naked put. You can see that there in the middle, $9.87 put, which is expiring on 9/21. Then right above that is the covered call that I did today, $11.50 call, expiring tomorrow, 10 sells. So if we go ahead and click on that, you can see some of the details behind this. Again, I'm selling off a call contract. You can see a -10 there. That's why it shows -10, because I sold off 10 contracts. Essentially got $2 for each contract. The account was credited $20, and you can see as collateral on the bottom there, stock collateral, 1,000 shares of Ford. Just to make sure we all understand what is happening, another trade here, click trade, view all options. And again, we are going to be selling a call here. Let's just take a call example here on April 13th. So this is identical to the one that I did for April 6th. Basically, I am going to be obligated to sell Ford for $11.50 on or before April 13th. As you can see on the bottom there, you're agreeing to sell 100 shares of Ford at $11.50 per share before or on April 13th. So if Ford does climb up beyond $11.50, I'll be obligated to buy, or excuse me, I'll be obligated to sell to a buyer at $11.50. Whoever buys the contract, whoever buys the covered call that I'm selling will have the opportunity to buy those shares from me at $11.50. So I will be obligated to sell the shares to them. If I am not asked to sell Ford by then, I'll be able to keep the collateral, which is essentially the 100 shares of Ford, as well as the full $9 credit for this particular trade. Again, it's 9 cents per stock. Each contract is 100 stocks, so you can see there the credit is simply 100 times 9 cents. So that is what a covered call is. So why would I do a covered call? Basically, I'm earning a premium on the price of Ford. So basically, by doing a covered call, I'm essentially making a rate of return on Ford, and I also put in a price that I'm comfortable selling Ford off as. So for example, let's say I wanted to do a limit sell order on Ford for $11.50. If I went ahead and put that in the normal fashion, if I simply went to trade, sell, then I would do simply a limit order here. Let's say $11.50. Let's say it never expires. And then I'll do 100 shares of Ford. This is identical to doing a covered call, only I will not be making a premium on this trade. I'll put that order in, and it'll essentially sit there until the stock reaches $11.50, and then the stock will be sold off, and I will get the proceeds from that transaction. The other way to make a rate of return on that particular trade is simply doing the options. So you go options here. Again, you're going to be selling a call. And you can really do this at any time point here. April 20th. Let's go ahead, kind of like an indefinite contract here. We'll go out as far as we can. Let's do January 17th, 2020. Again, we'll do the $11.50 call. They don't have $11.50 for January 17th. Let's click the closest one here, $11.87, for example. Again, we'll do one contract here. And you'll now see that I'll be doing the exact same thing as I did with that limit sell, only now I'll be earning $109 on the trade. And again, I don't have to necessarily keep that contract until that time. I can go ahead and buy back a call and essentially cancel out the contract, hopefully making a positive swing trade in the process. Basically, I'll buy it back for less than what the particular buyer of the contract had sold it for. So for example, on this put here, or on this call here, they basically paid me $20, essentially $2 per contract. I have 10 contracts, $20. If I could go ahead and buy those same contracts back for $10, I'd make $10 on the trade. So not a lot of money on the trade, but there's not a lot of risk, and I'm always willing to sell off the stock at the price of this call. So on a limit sell order, I simply would put that in and wait for it to execute. I would not make a rate of return. On a covered call, I'm doing the same exact contract, only I'm obligated to sell at $11.50, and the buyer of that contract will essentially pay me a premium, pay me money for having that opportunity to buy the stock from me. If the buyer of that contract wants that execution completed, then I will have to sell. I'll be obligated to sell, but I would already sell that at $11.50 anyway. That's the whole idea behind a limit sell order prior to the contract here on the call option. So might as well do a call options here, get premium on the contract. If I sell the stock off, great. I'm still selling it above my cost basis. The only drawback is that I would be limited on the profit I would make. So if the stock, for example, forward here goes up to $12, I couldn't sell it for $12. I'd still have to sell it for $11.50. It's still a positive swing trade for the portfolio. I still would earn that premium of $20, but the downside of this would be that I could not sell it for $12. So I essentially would miss that opportunity for the extra 50 cents per share, which would be a quite large rate of return. But again, I was willing to sell off the stock at $11.50, so I might as well get a rate of return by doing that in lieu of a limit sell order. So I hope that makes sense. Once you do a few of these contracts, it makes much more sense. It's very easy to understand. Essentially, instead of putting in a limit sell order for the portfolio, you're putting in covered call contract, which is doing the same thing, only you're going to get a premium rate of return by doing that. And again, you should only be doing this on stocks you are more than comfortable holding for the longer term, like Ford here, for example. I'm holding this for the long term. It's in the portfolio, so I might as well make a rate of return on the stock at a price that I'm willing to sell the stock off for. Again, knowing that if the stock does go up above that strike price, in my example here, $11.50, I will lose off on that extra profitability from the trade, but I still would have sold the stock off anyway in a limit sell order regardless. So I think it's a very good strategy. It's a great strategy for folks who have longer term buy and hold stocks that you want to make a premium on. So I'll be doing this as well as naked puts, and I'll go through naked puts in another video, again going through the entire strategy of what exactly I'm doing with those. So again, I don't want to make these videos too complex. I really want to hit on the key aspects of these, and as we do more of these trades, we'll go into a little bit more of the complex trading, some of the more sophisticated ways of using these types of strategies. But I think this is a very safe way of trading. There are a few risks, as I said. Again, you'll be limiting your upside on the stock, but if you're willing to sell off a stock at a particular price, you might as well do a covered call in lieu of a limit sell contract. And again, you can always sell these contracts off at a later point. You don't have to hold these until expiration. You can go ahead and do a swing trade on the contracts if it is favorable. If not, simply hold it until expiration, either selling off the stock for the strike price or simply having the contract expire and you keep the premium, you keep that rate of return on the stocks that you are already holding long in the portfolio. So I hope everyone understood the whole idea behind the covered call option strategy that I'm employing here. I'm going to be doing a lot more of these in the future. If you guys have any questions about this type of strategy, please let me know in the comment threads down below. Again, this is much more sophisticated, much more complex than simply buying and selling individual stocks, individual securities on the market. But the rate of return and some of the more complex strategies will definitely benefit investors in the long term with regards to getting a little extra rate of return out of very safe types of trades. Again, this can get real risky if you are holding volatile stocks. That's why I'm only going to be doing this in stocks that I am more than comfortable selling off at a particular price or buying at a particular price for naked puts and covered calls. So again, I don't want to make the video too long, so I'll kind of end it here. If you guys have any questions on this video, please let me know in the comment threads down below. And if you guys have any questions about any types of options trading, please let me know. I'm always looking for new things to read up on and new videos to publish about options trading. So not to make the video too long, I'll kind of end it here. Again, if you guys enjoy the content on the channel here, if you enjoy the video series, feel free to like, share, and subscribe. And until next video, we'll see you then.